What if a single war in the Middle East could shake the entire global economy? Not just oil prices, not just stock markets, but inflation, global trade, supply chains, and even the price of the groceries you buy every week. Whenever tensions rise around Iran, global markets start paying very close attention, because the region sits next to one of the most important energy choke points on Earth. And if a major conflict were to erupt there, the consequences could ripple far beyond the Middle East, across financial markets, across global trade, and across the everyday cost of living. At first glance, Iran might not seem like the center of the global economy, but geography tells a very different story. Iran sits next to one of the most strategically important shipping routes on the planet, the Strait of Hormuz. This narrow waterway connects the Persian Gulf to the open ocean, and every single day, roughly 20 million barrels of oil and petroleum products pass through this corridor. That represents around 1/5 of the world's seaborne oil trade. Oil from countries like Saudi Arabia, Iraq, Kuwait, and the United Arab Emirates must travel through this passage to reach global markets, which makes the Strait of Hormuz one of the most important energy choke points in the world. If that route were disrupted, even temporarily, global energy markets could experience severe volatility. And history shows that markets react quickly whenever tensions rise in this region. During previous geopolitical crises in the Middle East, oil prices have surged as investors price in the risk of supply disruptions. In severe disruption scenarios, some analysts warn that oil prices could spike well above $100 per barrel. And if that happens, the economic shock would not stop at energy markets. Oil is often described as the lifeblood of the global economy. It powers transportation, it fuels airplanes, cargo ships, trucks, and trains. It supports manufacturing, it drives agriculture, and it keeps global supply chains moving. Even today, oil still accounts for roughly 1/3 of the world's total energy consumption, which means when oil prices rise sharply, the effects ripple through the entire economy. Economists have long observed that sustained increases in oil prices tend to push inflation higher, because energy costs influence transportation, manufacturing, and food production. Think about how that works. If fuel becomes more expensive, airlines raise ticket prices, trucking companies charge more for deliveries, shipping costs increase, manufacturing becomes more expensive, and food transportation costs rise. Eventually, those higher costs move through the entire supply chain, and they reach consumers. That's how a geopolitical crisis thousands of miles away can suddenly make groceries, gasoline, and electricity more expensive. If you enjoy clear explanations of global events like this, consider subscribing to The Global Edge, where we break down the forces shaping the global economy. And this is exactly why economists watch energy markets so closely. Because if oil prices surge for an extended period, inflationary pressure can spread across the global economy. When inflation rises, central banks face a difficult decision. Their primary tool for controlling inflation is raising interest rates. But higher interest rates come with consequences. Borrowing becomes more expensive, mortgages become costlier, business loans become harder to obtain, investment slows down, and eventually economic growth begins to weaken. History offers a powerful example of this dilemma. During the 1973 oil crisis, global oil prices surged dramatically after an oil embargo by major Middle Eastern producers. Within months, oil prices had quadrupled, sending shockwaves through the global economy. The result was a dangerous combination of rising inflation and slow economic growth. Economists call this stagflation, a situation where prices rise while economic growth slows down. But the risks of a Middle East conflict extend far beyond oil. The region also sits at the crossroads of major global shipping routes connecting Europe, Asia, and Africa. Every day, thousands of cargo ships pass through these waters, carrying energy, raw materials, electronics, and consumer goods. If conflict were to disrupt shipping routes, global trade flows could be forced to reroute. That would mean shipping delays, higher transportation costs, and supply chain disruptions. The world already saw how fragile global supply chains can be during the COVID-19 pandemic. When ports shut down and shipping slowed, shortages quickly spread across the global economy. Whenever geopolitical tensions rise, financial markets react quickly. Investors often move their money into what economists call safe haven assets. These typically include gold, the US dollar, and government bonds. At the same time, riskier assets like stocks often become more volatile. Financial markets dislike uncertainty, and geopolitical conflicts tend to create a lot of it. The biggest concern among economists is not just a regional conflict, but a much wider regional war. If multiple countries became involved, particularly major oil producers, the global energy shock could become far more severe. Possible scenarios include major attacks on oil infrastructure, disruptions to shipping routes, or even the temporary closure of the Strait of Hormuz. If a large portion of global oil supply were suddenly disrupted, energy prices could surge dramatically. That would push inflation higher and slow global economic growth. And in extreme cases, it could even push parts of the global economy toward recession. The good news is that today's global economy is more resilient than it was during past energy crises. Many countries now maintain large strategic petroleum reserves designed specifically to stabilize supply during emergencies. Energy production is also far more diversified than it was decades ago. And some economies, including the United States, now produce significantly more domestic energy than they once did. So the impact of a conflict in the Middle East could be serious, but not necessarily catastrophic. Much depends on two key variables: how long the conflict lasts and whether it spreads beyond the region. Because wars don't just reshape geopolitics, they reshape economies. And the Middle East remains one of the most strategically important energy regions on the planet. If tensions remain contained, the global economy may be able to absorb the shock. But if the conflict escalates, the ripple effects could be felt everywhere, from Wall Street to gas stations to grocery stores around the world. Because in a globalized economy, even a war thousands of miles away can affect everyone. If you want to understand the real forces shaping global power and the world economy, subscribe to The Global Edge, because the biggest stories in geopolitics are often the ones that impact your life the most.